A lot of factors go into the decision to buy a particular stock. One, of course, is how well the underlying company is doing, but equally important, considering whether the stock price itself makes sense. If the price is too high, the stock is said to be overvalued and ripe for a fall, and an investor could end up losing money. On the other hand, they could make a killing if the stock is undervalued or priced too low. But how do you tell? One method is to look at a company's price to book ratio, or PB ratio for short. It's a quick metric that evaluates the market price of a stock that can be used to compare it to others in a similar space. The PB ratio may signal whether the per share price is reasonable, lower than it should be, or way too high. Let's look at how to figure out the PB ratio and how to interpret it. The price to book ratio expresses a company's stock share price in relation to its book value per share, BVPS. Book value refers to a company's intrinsic financial worth, specifically the difference between all its assets and all its expenses and debts. Though officially a ratio, the PB ratio is often just expressed as a single number. Some stock listing and research sites list the PB ratio, or you could also calculate the PB ratio on your own. The book value is the amount that would be left if the company liquidated all of its assets and repaid all of its liabilities. The book value equals the net assets of the company and comes from the balance sheet. The price to book ratio is important because it can help investors understand whether the market price of a company seems reasonable when compared to its balance sheet. In other words, the ratio is used to compare the business's net assets that are available in relation to the sales price of its stock. In order to calculate the PB ratio, first get the current share price of the stock you want to look into. Next, determine the book value per share. The easy way is to look up the financial stock listing. You may have to scroll down a bit to find it. Alternatively, to find it yourself, the first move is to figure out the book value or net book value, which is the difference between the company's total assets and total liabilities. That begins with looking up a company's balance sheet. Once you have those two figures, book value is the difference between the company's total liabilities and its total assets as reflected on the balance sheet. Now, finally, determine the book value per share. Divide the book value from the number of outstanding shares on a particular date. Now you have the book value per share of a single share of a company stock. Lastly, you just divide the share price by the book value per share, and that's your price to book ratio. Some analysts say a PB ratio of less than 1 indicates that a stock is undervalued and, everything else being equal, it may be poised for a rise. A 1 ratio, though, may indicate fair pricing, where the market value is equal to the company's book value. A PB ratio of 3 or higher, however, could signal a market value that's too high and may be ready for a fall. Having said that, it's tricky to determine a single standard for good or bad PB ratios. Every industry has a very different range. What's high in one field may be low in another. That's because a manufacturer, for example, will have a lot more assets on the books than, say, a services company. Or a truck operation company will have more overhead expenses than, say, an online bank. Differences like that could lead to unrealistic company to company comparisons. So, while the price to book ratio analysis may be useful in weighing valuations between companies, you should be careful to compare apples to apples or companies in similar industries. That's one reason the PB ratio is a tool to be used in conjunction with other ratios and one of many indicators of relative valuation. Here is a simple example. Let's say the ABC company had a net book value of 10 million and had 10 million shares outstanding on a certain date. Its net book value per share would be the 10 million divided by the 10 million shares, and that would be 1, meaning that an investor is essentially paying $1 for one share of a company's net book value. If the price of ABC was $2 a share, then the PB ratio would be 2, which signals the investor is paying $2 for each share of a company's net book value. The investor could track ABC's price to book ratio over a period of time and see if it's holding steady, rising, or falling. The ratio could also let you compare the ABC company to another one in the same industry, let's say XYZ company. If XYZ had a higher price to book ratio, say 6, it could signal that the market is anticipating strong earnings growth for this firm and bidding up the shares in anticipation. An investor might conclude that XYZ was already overvalued. Conversely, if XYZ company had a price to book ratio of 0.5, the stock price might be considered to be trading at a discount since investors are paying below book value for it, and it could be a bargain. Then again, it may not be that good. The price to book ratio has been used for a long time, but there are some drawbacks that have driven it to fall out of favor among some investors. For one thing, price to book doesn't account for hard to value intangible assets like patents or other intellectual property. The book value is an accounting concept that's generally based on the lower of the asset's cost or market value. So the book value can understate a company's per share net asset value. And by potentially reducing the book value per share, the price to book ratio may appear to be artificially high. If you think about something like Apple, at the time of writing, it has a price to book ratio of 38.29. However, the company derives a lot of its value from patents and other hard to value intangible assets. But someone who invests strictly by its huge price to book ratio, they would say it's overvalued, when it might not necessarily be the case. That's why a price to book ratio, especially as a standalone tool, may not work for things like tech companies. It's designed more for capital intensive, old economy companies like manufacturing and mining firms. Still, there are advocates of value investing who seek out low performing but intrinsically solid stocks with the goal of profiting when their prices rise. They often swear by the price to book ratio. It's a quick trick to analyze the stock price against the company's balance sheet, its financial fundamentals, and sniff out a bargain. Price to book analysis may also be particularly useful for stocks in cyclical sectors, which rise during boom economy times but see prices fall during recessions. Even though their underlying fundamentals appear to be sound, value investors tend to favor cyclical stocks, especially if they can get it right before the recovery. The price to book ratio can offer some idea about whether an individual stock is a good buy in relation to others in the industry segment, or sometimes even the overall market. Focusing on fundamentals, the book value, and the share price, it can tune out speculative static that is currently distorting prices up or down. Comparing a single company's price to book ratio over time may help indicate whether it's likely to do better or worse in the future, but the price to book ratio is at the end of the day only one way to evaluate a stock.